Welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can subscribe to all our podcasts at americastalking.com. To support Everyday Economics, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording today's episode on Friday, March 22nd, and joining me as always, my friend and colleague, Dr. Orphe Divounguy, PhD economist. Dr. O, it's good to be with you again. Hey, I want to jump right into the sort of the news of the moment. The Federal Reserve came out with its Federal Open Market Committee statement on Wednesday afternoon, and prior to that, the markets were pretty edgy. Somewhat defensive behavior in the market. A lot of things were being sold off. The markets kind of went down, and then the Fed came out and said, things aren't so bad, and the markets went up. I'm oversimplifying, of course. Tell me what I need to know.
Yeah, well, first I was really surprised by the market reaction, right? First, 10-year Treasury yields have been declining since the Fed meeting. The 10-year Treasury yield depends on future inflation and future economic growth. And what the Fed did is it pointed to stronger economic growth. And let's put some numbers to it. When compared to the December summary of economic projections, they penciled a 2.1% real GDP growth as opposed to 1.4%. They pointed to less disinflation at 2.6% core inflation, core PCE, as opposed to 2.4% in their December meeting. And then they pointed to a lower unemployment rate at 4% versus 4.1%. And so they're pointing to a stronger economy. They're pointing to less disinflation than was previously anticipated. And instead of the market reacting with yields rising, yields went down and continued to tick down. And so I thought that was really interesting. And perhaps it's the result of Fed Chair Powell not making a lot of sense during his press conference. On one hand, we see the individual projections from Fed officials pointing to less disinflation, higher economic growth. Sorry, let me say the Fed forecast pointing to less disinflation, higher economic growth. The Fed dot plot, the individual projections from the FOMC participants pointing to, by the way, yes, they're still pointing to 3 rate cuts potentially. But if you look at the distribution of their forecasts, the average rate has moved up. The median is still 4.6%, but the dots have moved up. And maybe only one member now points to more than 3 cuts. In December, five members were pointing to potentially more than 3 rate cuts. And so you have this shift up in the trajectory. And yet the market did not looked past that, looked beyond that, and focused only on the press conference. And in the press conference, Chair Powell basically tried to provide some reassurances that the latest inflation data, which basically had showed stronger than expected inflation, had not changed the committee's perception about the potential path of inflation and the policy rate. But it's clear from the dot plot that there were some changes. It's clear from the forecast that there were some revisions to the way they were thinking about it. But during the press conference, Powell basically said, hey, everything's fine. We're still going to get 3 rate cuts, but...
And nobody has stepped out. I mean, the entire group of deputies at the Fed is in line with what Jerome Powell is saying. They all voted the same way on this.
Well, not totally, but I don't know if everybody's in line with what he's saying. I'm not sure what he's saying actually. It's hard to reconcile what he's saying with what was in the summary of economic projections.
Right, but there's been no public dissent from any of the deputy governors. But for the benefit of the process, if there was some level of disagreement, it could have been expressed, and it has been expressed in the past, in that FOMC report. And now we're not seeing anything like that.
For sure. Maybe not, no dissent for sure. But I think that's coming, right? So let me just go into what he said. He says, we need more conclusive evidence that inflation is getting back to the 2% target, blah, 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 before making a decision on a rate cut. Well, where is that evidence going to come from? We're almost in June already. And then he says to being pushed by a reporter, he says, yeah, usually inflation prints are lower in the second half of the year. That to me hints that there's no rate cut coming in June. Because if the inflation readings up until June are still strong, then we are not going to have the conclusive evidence that the Fed needs to get us a rate cut by June. So that's probably not happening, right? And so when you say 3 rate cuts in 2024, does he actually mean 3 rate cuts at the end of the year before and around the presidential election? I think that raises a red flag to me because, first of all, it's really hard for me to imagine the Fed cutting before the presidential election, regardless of what the data says, just because of the optics, right? And so what does it mean? Like, when are those rate cuts coming? Are they coming, in the second half of the year? Okay, maybe, sure. If the inflation readings are low and towards October, November, sure. But that's also coincides with the timing of the election. And I don't know how many times the Fed has cut right before presidential election without it looking kind of weird, even though I think they would be doing the right thing. If inflation comes down lower, they would have to cut. But will they do it? So anyway, I just don't know when those readings are coming that will make the Fed confident that it's time to cut interest rates. I just don't see them in the first half of this year. I don't think we're going to get those readings. And then at the same time, the market reaction to stronger than anticipated inflation, stronger than anticipated GDP growth is odd to me. It's really odd. It's almost like some sort of irrational exuberance. We're going to continue to believe something that isn't a reality. You look at market rent growth has ticked higher for the past 2 consecutive months. If we think rent growth in the CPI is going to come down, following market rent growth, well, let me just be the bearer of bad news. Rent growth in the market rent growth is no longer slowing. It's been pretty much flat. Single family rent growth has ticked up. Multifamily rent growth continues to ease barely. And so, okay, so where's that disinflation coming from? The Fed says 2.6% core PCE by the end of the year. Well, that means we don't have much disinflation left for the rest of this year. And so I'm starting to think we're going to have fewer than 3 rate cuts, maybe even fewer than 2 rate cuts in 2024.
Yeah, we're running out of months.
You heard it here first. That's my forecast based on the economic data that I'm seeing out there. And potentially yields not coming down, continuing to come down, but perhaps coming back up when the market fully realizes that.
Appreciate your insights as always. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.
Knowledge is power, and you deserve to know what happens in your state government. That's why the Center Square's reporting zeroes in on state authorities publishing stories that show where your money goes and who spends it. The Center Square gives power to the taxpayer by tracking politicians' use of the people's money and demanding transparency from state-run agencies. This is how the Center Square equips you, the American taxpayer, to hold your state government accountable. Sign up now for your state's Center Square newsletter at thecentersquare.com.